Welcome to the Victor H Investing live stream. Today is June 8th, 2024, and we had a good week of trading this week. Certainly was interesting, and we saw stocks rise overall. There was a lot of highlights, especially around technology, and we can cover that as well as look at some individual stocks. It's been a good year so far. It's the S&P's up more than 12%. My portfolio is up about the same amount, and the performance has been great. I would love for it to continue. It's just hard to imagine that it'll continue without having some setbacks. It's quite all right and quite natural to have some pullbacks and some corrections along the way. I expect some of that for the remainder of 2024. Not sure if it's going to happen soon or if it's going to happen in a while, but we'll see. So before I jump into a lot of the information, thanks everybody for joining. Please ask questions. Let me know if there's a stock that you'd like to take a look at. We can dive into it and see what it looks like and take a look at it. Let me, all right. So the S&P over the past 5 days, it was up about 1%. And hey, Anderson, thanks for showing up, man. Appreciate it. Very nice to have you. Let's go. Exactly. Last 5 days, it was up about 1%, which is very good. Year to date, it's up 12.74%. The NASDAQ's even doing better. The Russell continues to lag, and those are small stocks, small cap stocks. This week, it was down 2.36%. And for the year, it's pretty much flat. So I'm being careful as I buy small caps, small companies, because right now they just aren't getting the love that the bigger caps are getting. And that's just kind of a reality check, right? We can think, man, that's unfortunate that some of these high growth, smaller companies aren't getting the love. But maybe someday soon, these stocks will start rallying because there's been a lot of pent up, I think, appreciation. Some of these stocks have better PE ratios. If we look at their earnings per share, there's a lot of uncovered value in free cash flows in a lot of these companies. We'll see. We'll see when they start to rally. The Dow is also doing quite well. If we look at the Dow Jones, I know it's had a couple, like this week it was up 0.5. For the month, it's flat. For the year, it's up 2.87. And that's interesting because my income portfolio, which is made up of mostly Dow stocks, it's doing really well. I'm getting dividends and I'm seeing appreciation, which is really good to see. Looks like Caroline just started following you. I forgot that I was looking at exactly, but do you have any opinions on TMF, TLT? Would appreciate your input. Yeah, happy to do that. So we'll take a look at those. Yep, we can cover those. Thanks for asking. Thanks for joining today. A couple of things that I wanted to cover off just really quick. I have a new partnership with Moo, and this is a sponsor. I appreciate their support. And if you'd like to take a look at Moo and getting signed up, it's in the description of this live stream as well as on the channel's community page. What I thought was pretty attractive is for 3 months, you can earn 8.1%, which is a really nice yield. And then after that, 5.1. And they have a 15 free stock offer if you deposit $1,000. I'm waiting for my 15 stocks to be issued. I deposited my $1,000 and I'll see what stocks I get. That'd be interesting to see. The other thing I'd highlight is the Wall Street Journal reached out to me a couple weeks ago and asked if I wanted to be a part of a story. And I said, yeah, I'd be happy to participate. And David Uberti included me in a story that actually published in print on Thursday and digital on the Wall Street Journal on Wednesday. And it was pretty cool that he got my comments and he actually cited a lot of things that I said around inflation and what I'm doing with how higher interest rates have changed both my spend and my investing, and how I've gone into a little more fixed income because of the higher interest rates. So it's a pretty good read. And for me, it was pretty cool to have a newspaper that I've been reading since my college days. It was recommended that I read the Wall Street Journal. Reach out to me and want my comments on an article. I thought that was pretty cool, and it's on the channel community page, and you can read it at your leisure. But that was a cool thing that happened to me this week. All right, so let's take a look at the two symbols that Carolyn wanted to take a look at. So TMF. So this is the Direction Daily 20 plus year Treasury Bull 3X shares. This is an exchange traded fund that is based on the 20-year Treasury 20 plus year index. The fund provides 3X daily exposure to a market value weighted index US Treasury bonds with 20 years of maturity. So this is an ETF with long-term bonds. This is a really interesting look for a couple reasons, but let's take a look at a few things real quick. So year to date, it's lost value. Over the last 5 years, it's lost a lot of value. And I can tell you why I think that's the case. This pays a high dividend if compared to a dividend paying stock. Now, why would somebody want to invest in a long-term treasury? So you want to get into long-term treasuries when you believe the interest rates are going to go down. And we are in a higher interest rate environment than before. Let me pull up a quick chart on interest rates. And the reason I want to show the chart is so that we can kind of get our heads around, where these rates have been. So I'm not going to go 20 year. I'm actually going to go to the 10 year, which is the most popular cited interest rate. And if we look at historically, right, in 81, interest rates were really high, above 10%, up around 15%. Isn't that incredible? And then over time, interest rates have really gradually gone down to the point where during COVID, they were super low. And if you bought long-term bonds back here, you'd be really losing money over time because bond values go down as interest rates go down. The opposite. Bond values go up in value as interest rates fall. Bond values will lose value, bond prices, as interest rates rise. So if you had, at this time here, when it was high interest rates, if you had said, I want to get into a long-term bond, a long-term ETF, and lock in some of these high interest rates, you'd look like a genius, because each year, as if you locked in like 10, 12%, and 10, 20 years later, you're still earning that. Everybody else is earning a third of that. That's what a long-term bond can do for you. The question is, looking at the last 5 years, we've seen a rise in interest rates. It certainly has. Historically, it's not setting any records, right? We're just kind of getting back to maybe around the 2006 era. So the question that, as you look at these long-term bonds, and if you look at the performance, right? Remember how I showed that this has been going down in value because interest rates have been going up. Now, if you believe that interest rates are either going to stay flat or potentially go down, this would be an ETF that would go up in value. I don't know if they're going to go up much more. I think they're going to go down a little bit. That's my forecast. So that's part of my kind of opinion on an ETF with long-term bonds. I don't think it's a bad idea. I think a lot of the drop in the value of this ETF has happened. And at this point, you can pick it up and earn a yield of 3.67, which would be a dividend. Okay, so you get paid a dividend. The ETF owns these long-term treasuries. Not sure what your objective is, Caroline, on your portfolio. If you're looking for income, long-term bonds could be risky because you could lose a lot of money, or you can lose value. Meanwhile, you don't get a very, very high yield. So I'd really be careful not to buy too much. And I'd really want to understand, what is it that you need out of this? Is it that, hey, you know what? I'm buying this for a situation. I'm going to use an example, probably not the case here, but let's say I had an elderly parent and I'm like, I want to put this in and I want to make sure they get, a 3%, 4% income per year. That might be an idea, but there has to be a reason why you would want to commit for this long-term duration. And I know you can get in and out of this ETF. The best rates you can get on right now is short-term bonds. We had the yield nerd on this channel a couple weeks ago, where he's getting the best yield is very short term. That's where you're getting the best yield. So as shown earlier, in Moomoo will pay you 8.1% for 3 months. That's way higher than this. So those are my comments on this long-term bond. Last thing I'll put out there is Silicon Valley Bank went bankrupt in 2023 because they bought a bunch of long-term bonds. The value of those bonds went down pretty much like this. They had to write down those bonds. It scared investors, and they took a run on the bank. So those are the things that I would say about long-term bonds. Looking at the other symbol you were interested is TLT. Yeah, this is similar long-term bonds. Ditto what I just said. So just think about it. Be observant of what you're getting into with long-term bonds. I don't have a lot of long-term bonds. I think I have one with like Apple and one with in very small amounts, and one with J&J, Johnson & Johnson. But it's not anything big about nothing big in my portfolio. All right. Good to see you, Anderson. Vale. Yeah, we can look at Vale, definitely. And let me catch up on comments. I'm hoping it's a 16, 18 month play with 50 to 200% upside. I believe content on this will be popular. Buffett sold 13% Apple. I wonder if there's big money going. Buffett's buying treasuries, but I think he's buying short-term treasuries. And I haven't looked at it very closely, but the details that I got was that he was buying short-term treasuries. So I'm curious to see why you're looking at long-term bonds. To me, when you get into a long-term bond, there's a lot of risks there. Now, back I showed you the chart of 1981. If you could get into a yield of 10, 12%, yeah, why not do it? That's a great yield. If you lose a little bit of your principal, who cares? You're making 10, 12%. But at the rates where a long-term bond's paying you, which is 3.5%, 4%, that's not very good. If you just leave your money in cash, you're making 5% minimum, maybe even more. So the risk to reward ratio just isn't there for me. I would be pumping the brakes on that, but that's me. That's my portfolio. I'm 55. I'm going to need income, but I always have to feel like the risk to reward ratio is going to compensate me well, or I'll just leave it in cash because I'm making good money on cash. So hopefully that was helpful, Caroline. Hey, Vic, what's up? Can you take a look at Forward Air Corporation and Carriage? Yeah, most definitely. Winter is coming. Thanks for showing up. But I think summer's coming before winter. And I'm happy about that. Looking forward to doing some travel this summer and having some fun. This is like, yeah, Yeah, this is like the late spring, early summer. We'll see how it goes. So thanks for showing up. Winter's coming. Appreciate it. And yes, definitely similar play up. Yeah, you're welcome. Thanks for asking that question. It really made me think. I hadn't been asked about long-term bonds. I do think about them once in a while. So Neil, good to see you, Neil. So I think you want to see Whirlpool, right? Glad to take a look at Whirlpool. Forgot the symbol. Is it WHR? I think it is. We'll take a look. And then domain. Not quite understand that. Domain REITs for you. All right. All right, cool. So let's get into some of these symbols, starting with Vale. I think is it Vale, the oil company down in Brazil? So Vale, or maybe Vale, together with its subsidiaries, produces and sells iron ore and iron ore pellets for the use in raw materials steelmaking in Brazil and internationally. So it's a steel company in Brazil, and it produces a lot of steel. Now, this company I had looked at a couple years ago, and I thought they had a really good return. They did have a little bit of controversy. I think they had some mine accidents that got them some really bad press, and it was deserved because some people died and some people got hurt. It happened a while ago, but it did happen. Now, this company is a $48 billion market cap company. It has a dividend of 12%. That is really nice. And revenue is, you're almost paying one-time revenue for the company. The price, analysts believe that it's discounted by 47%. Looking at their financials, their revenues have been going down. These guys are dependent on commodity prices for iron ore and all the other metals that they're extracting and getting out of their mines. Looking at the quarterly, I don't have quarterly data on this one. So revenue is coming down, but it's not probably their fault. It's that commodity prices are not in high demand right now. If the economy really begins to grow, the global economy or certain economies like China begin to grow, you could see commodity prices rise, and that would really benefit this company. This company in the past, I've looked at it. Let me take a look at their balance sheet. Cash and cash equivalents, and this is in US dollars. Okay, good. 3.9 billion. Total debt, 22 billion. Okay. So they have net about 18 billion. If we look at their EBITDA, 18 billion is their total net debt. And if I look at their EBITDA, it's 12.5 billion. So they have less than 3 times EBITDA of debt. Their balance sheet is good in my book. Looking at their free cash flow, I'm expecting these guys really cash flow well, and they do. I could tell you that this company would probably look like it's undervalued to me, and I own TX. I'll show you TX as a comparison. TX is similar. They operate in Mexico. Mexico is now the number one trading partner with the U.S. They also do some mining of steel, but they also do rolled steel products, and they sell that to an end market being mostly the United States. They also have operations down in Argentina, and this has been a really good stock for me. It's appreciated, and it's paid me a really high dividend. So I wouldn't have a need for this company, but I can tell you I've done really well with these types of mining materials companies. I would pick one that you feel most comfortable with. I think there's upside in these companies. If we look at the 5-year, you see it hasn't really gone up and to the right nice and consistently, but it may be that if the economy starts getting, going around the world, material prices are going to go up. And if those commodity prices go up, these companies make a lot of money. You're going to see their stock price go up. This company has been about kind of like the same, less volatility, TX, but they both pay a very high dividend. And it's an idea. If you want a high return in the form of dividend and some appreciation should the economy really start to grow, those are two really good options. All right, let's take a look at the next symbol, which is FWRD. Forward Air Corporation, together with its subsidiaries, operates as an asset-light freight and logistics company in the U.S. and Canada. It operates two segments, expedited freight and intermodal. Okay, so this is a freight company. They run tractor trailers and they're moving cargo around the United States. So their market cap's low compared to their revenue. It's a $546 million company, so it's a small cap. Reasonable, small dividend. Wow, analysts believe it's really discounted. What's been going on with the stock? It's down 80% in 1 year. So first impression is, why are they down at 80%? Is there like some economic problem with the company? PE ratio is low. Forward PE is a little bit higher. Financials, their revenue did go down in 2023, but the revenue was really growing. If you recall, we had really supply chain issues a couple years ago. It caused a lot of high prices. Well, these guys were probably cleaning up in those days, charging higher rates to move freight around in the United States. So I think they really benefited and they grew their company nicely. But now in 2023, the revenues have come down. Looking at the last quarter, revenues did pick up. Comparing the quarter that ended March 31st compared to the same quarter a year prior, they grew by like 51%. That's phenomenal. So if you believe that this company is going to keep growing, this is a really interesting stock. Let's look at their balance sheet. So this could be on its way to really doing well if they can keep growing. The balance sheet, they have cash of 172 million, total debt of 2 billion. And if we look at their EBITDA, 200 million. So they have a net. Yeah, this balance sheet isn't very good because their EBITDA is about 200 million. Their net debt is going to be about 1.8 billion. So you're at 9 times EBITDA for debt, which is a disqualifier in my book. Their balance sheet has too much debt. When we look at their cash flow, free cash flow is 154 million in the most recent full year, which is good compared to their, you think about this, right? 154 of free cash flow. Their market cap is 546. So this company is generating like a quarter of their market cap in free cash flow. That's how low their market cap has gotten. The big question is, why is their balance sheet so out of whack? Debt to EBITDA of 10.4 comparing to this website. I did it in my head. Net debt, these guys are using full debt. I thought it was a 9, but I guess our numbers are similar because these guys are taking debt and I took cash away from debt. So this would be my biggest worry about the company, and the fact that this is a tiny company. In tiny companies, I started off the live stream talking about how small caps are just not getting a lot of love. Small caps are not seeing their stock prices rise. And here's another example of what's been going on for the past year. You have these tiny companies. I mean, if these guys can, start paying off some of that debt, get their balance sheet back in order, and if they can grow their business, this is a big winning stock. What's the stock done over the last 5 days? Is up 21%. Holy smokes. So this is an interesting one. It's risky, but it's interesting. They're putting up some of these numbers look really interesting. It might be, you know, you want to get into a stock kind of early, but not too early. Be waiting around a year for something to happen. This one, if it takes off to the upside, I think it's beginning to take off. We'll see, but really interesting suggestion on a stock to look at. Let's take a look at CSV. I think I am familiar with CSV. So these guys, Carriage Services provides funeral and cemetery services, merchandise in the United States. It operates two segments: funeral home operations and cemetery operations. Small cap, tiny cap, 429 million. Revenue is 390 million. Low dividend. Forward PE is 11.8. They have, it's interesting how their revenue has really fluctuated. They had a drop in 2022 and then an increase in 2023. Revenues are increasing the most current quarter. Okay, so modest growth, which I wouldn't expect this company to be growing by leaps and bounds, because it is in a particular type of industry where they're helping families and loved ones, bury a loved one, or maybe cremate a person that has died recently. All right, so reasonable growth based on their industry. They have very little cash, and they operate with almost no cash. They have some debt, 600 million. We look at their debt to EBITDA. It's 5.5. It's high. So their balance sheet's not perfect. And their cash flow is $57 million in the last full year. So this one would probably price out to have a small discount. That balance sheet worries me. And the fact that it's a tiny company also worries me. Small companies are not getting great valuations. So this one's not as interesting as this Forward Air. This one, I think if things start lining up and think these guys get a few breaks, this stock could be double its value in no time, because I'm just seeing some things where this one might be about to take off. So good ones. Thank you. I think the next one is Whirlpool. Whirlpool, I did a video on recently, I would say in the last couple of weeks, and my opinion on it was to stay away. And the main reason was, they're paying a high dividend. I don't know that they can afford that dividend, frankly, but they're one of these dividend aristocrats, so they're going to try to keep it. That's fine. But the health of the business is what worried me. They have declining sales. They just acquired a company in Europe. They're trying to bring that company into their revenue stream. But look at their last quarter. They lost, revenue went down. And if we look at their profitability, I think that was another part that I just say in the quarter. So here's the revenue, and they lost money. So they're losing money. Revenue's gone down. There was just a lot of bad news in the last earnings report. And, is the light at the end of the tunnel close or far? Well, when you look at a lot of the products that they sell are these products that last, 5-10 years. Like we got a refrigerator recently. It's not a Whirlpool product. I've bought their products before, but it's one of those things where I don't need a refrigerator every other year. I don't know, every 10 years, every 5 years, a washing machine, dishwasher. Again, I'd rather go every 10 years and then get a nice model that's going to last. Well, they had a big COVID, boost, and then they've been kind of lacking demand ever since. And at what point will we see Whirlpool products come back and be in demand? Well, we don't have a lot of construction activity. High interest rates and the unwillingness of people to want to sell their homes has really kept real estate transactions down. So Whirlpool, I thought, was something I didn't want to touch until they figured out their business. And we can see that they're going to start growing in the next 12 months. I think they're going to have a tough, couple of years. And if we look at the annual return down 40%, and you see that during COVID, they were selling a lot of products. So they had a high of 252. Now they're down to 88. So that was my opinion on Whirlpool. It's a stock that I'm just not touching because just got too many problems that need to be resolved. All right. So I'm backed up on comments. Let me catch up. So Josh Samuel, thanks for showing up. Appreciate you coming. Good evening. I do have a real estate question for you. What do you think about younger people investing in real estate REITs? Yeah, so that's two questions there. And let me tell you about real estate. And let me catch up with the other comment too. Is the market too high in real estate? Yeah, so that's a very good question, Josh. Let me share some comments with you. So on real estate, I've invested in real estate individual transactions, buying a property, and I've bought property to live in. I live in this house. I bought it 25 years ago, but I also buy real estate and I rent it out to people that want to live in that real estate. And I've been doing that since 2010. And I timed it because in 2010, if you recall, that was when the subprime market, The Big Short, that movie, that's when things became really ugly for real estate. And few people wanted to buy real estate. But I thought, man, it'd be a great investment. So I bought 5 properties and I did really, really well. Okay. Put a period on that. I've owned real estate and saw that the short-term rental market was really booming. And we bought 2 properties and put them on, Airbnb. We did great, made lots of money. And it was overall, it was a positive enterprise. Going into COVID, I thought real estate's going to crash. With all this fear, I think that people are going to be really reluctant to do transactions. And I've been surprised how real estate's operated. The home builders have done well. But overall, in my opinion, you're beginning to see real estate markets falter. There's a couple of big markets, for example, in Texas, the Austin market, you're seeing prices go down, and you're seeing prices go down in San Antonio. You're seeing a couple of markets in the US where prices are going down. So I have 2 sons, 24, 19. The 24-year-old, would I recommend that he buy a real estate asset right now to live in? No. I think the real estate market's going to show us what it's going to do over the next 5 years. And what I would be afraid of if I was giving advice to my 24-year-old is that you buy a house or a condominium or whatever ends up being the transaction, and you buy it at a price that it's being sold at in 2024. Prices go down and it takes you 10 to 15 years to get back to even. That's the reality with real estate. I know people that bought in the wrong time, like around 2007 at the height of real estate, and it took them over 10 years just to break even on that transaction. If they had waited just 3 years, they would have gotten that same home at a 40% discount. And on a home purchase, that's a lot of money. When you buy a home, you're committing to paying that loan. And just to use round numbers, right? I'm in California, so real estate's really expensive. And if you bought a home for $800,000 and you put, let's say, 10% down, well, you're going to be on the hook to pay $710,000 over the next 30 years on a 30-year fixed. Well, it would be really hard to see the market correct and go down, and that same house is being sold, instead of $800, being sold for $600. It'd be very difficult to stomach. And that's why I would not advise one of my sons to buy real estate right now. Now, buying REITs. Certain REITs are a very good idea. REITs allow you to buy into real estate, invest into the real estate market, but pick and choose the sectors that you want to be a part of. I own a couple REITs. One of them provides housing to the elderly that need healthcare, and that's Care Trust. It's been a good REIT. I bought it when it was substantially lower. So I have good appreciation. They pay good dividend. But I don't buy a whole lot more in REITs because I already own real estate direct, and I have, my properties are cash positive, and I just hold them because I have a very good acquisition price, and I'm going to continue to hold them. But REITs are a way to get in there. Now, over the long haul, I would always say buying a real estate, house or condo to live in is a very good idea. It's just you got to wait for the market to be right. Judging from Southern California, I would not be buying real estate in Southern California to live in. I think it's going to take a couple of years to get the market right. But once you buy into a property, you get to lock in your cost of living, and it's a very good idea long term. Okay, so those are comments from one guy, one investor. I do have some experience in it. Hopefully you found those comments interesting, and good luck, Josh. Thanks for the question. I've been buying. Oh, yeah. So Realty Income is one of the most popular REITs. They pay a monthly dividend, which is kind of neat. So they pay monthly, and they rent out a lot of the what I think of as like small open air, retail properties. And it's not my favorite REIT, and here's why. I think a lot of the people that these companies have historically rented out to could find themselves in trouble. Retail, right? Retail's tough. You have, like, for example, Rite Aid is completely bankrupt. Well, how many Rite Aids does Realty Income have in their portfolio where they leased out to Rite Aid? Walgreens is in trouble. Okay, well, there's another one. Restaurants get themselves into trouble. Restaurants just really tough business. So it's not my favorite REIT. I like REITs where, like I talked about Care Trust. You're talking about like older people that tend to have a couple of things: A, savings; B, government assistance of some sort, either through Medicare and other benefits that are provided. Those are very good sources of stable income for those properties. So that's just a comment on symbol O, and a lot of people like that particular REIT. I think a lot of people can get their heads around it, and good luck with it. All right, another question from Josh. The market seems to be too high priced and outrageous. Yeah, so you're observing what I'm observing, Josh, with real estate. When you look at Southern California, when I was a boy a long time ago, you could buy a house for $20,000. That same house is literally $1 million today. It's freaking nuts how people have to put so much on the line to buy a house to live in. To me, it's so out of reach that it's going to correct, because who can afford that? Not a lot of people. With higher interest rates, right? This house here that I'm sitting in, I refinanced a couple of years back. I have a 2.5% fixed rate, and that's a great rate. And I did it for 15 years, and I think I did it, I don't know, 4 years ago, and got into a good situation. But at 7%, the interest rate just really racks up. And with high prices and a higher interest rate, it's just too much. I would not be surprised that 2 years later, you would see prices that are like 20% less, maybe 30% less. And hopefully interest rates go down, because the Fed's supposed to cut rates. And hopefully, that interest rate goes from 7 to maybe 6, maybe 5.5. And that would be huge, because you'd be saving on price and interest rate, maybe $300-400 a month for the next 30 years. That's a lot of money. So what you're seeing, I'm seeing, Josh, and please keep asking questions. When you ask questions and you learn from other people, it's literally free and you learn something. But when you buy real estate and then learn by, doing it, it's very expensive. It's very painful. All right, so I'm younger and doing drip. Awesome. And it looks like, okay, comments. And it looks like I'm not catching up with the comments. I'm sorry, I'm kind of out of context on these. 3 toys to play with: Stanley, Black & Decker, Nokia, Ericsson. Okay, cool. Let's take a look at these. So Stanley Black & Decker, they do like power tools. SWK is a symbol. So interesting, over the last year, it's down 4.59, pays a nice dividend, low market cap. This is a well-known company. Where are they headquartered? So Stanley Black & Decker provides hand tools, power tools, outdoor products. Yep, that's the company. They've been around since 1843. Wow, that's a while. They were doing really well when everybody was improving their own home and going to Home Depot to buy cordless drills and all kinds of stuff so they could fix up their houses, but they've really gone down. The revenue really had a high in 2021, and then they had a loss of revenue in 2023. They continue to lose revenue in the most recent quarter. Okay. This one here, so it's a $12.6 billion company. If we look at their cash flow, it's an $852 million cash flow. And I don't like seeing cash flow when it's this erratic. 852 million in free cash flow in the most recent full year, but the year before it was negative free cash flow of almost 2 billion, and then 144. So there's no like good smooth data set. This is kind of all over the place. All right, so that's that. Let's see the quarterly. And in the quarterly, look at the cash flow. Yeah, the data is really bad on this company. It's hard to do a forecast because you go from, hey, this quarter they did 633, and I think it was because it's the last quarter of that year, and then it drops. So this one here is just, I think it's trying to repair itself from a fundamentals perspective. And yeah, this one doesn't excite me. I think there's a lot of things going on. I would have to wait for the fundamentals to get better and for projections to be easier to make on it. Right now, it's kind of like a coin flip. And I don't know if this one's going to be like a home run, like, go up 100%. This one might have a modest gain. It's down a lot. Can it get back to its, pre-COVID high? Probably. But its fundamentals look pretty bad right now. Its fundamentals look like it's a troubled company. So that's a Stanley Black & Decker. Nokia. So Nokia. So I've seen this stock from time to time, and some investors are really into this stock. So 4.4% dividend. It's down. It's a low price stock. It's down quite a bit over the 5-year. It's down a little bit there. So Nokia provides mobile, fixed, and cloud network solutions. Yep. That's the company. So 1 times revenue. This is a communications, not a communications company. It's more of like a technology device company. And the revenue did go down in 23. I don't get any quarterly. Free cash flow. They do cash flow really well. Really good free cash flow. Yeah, this one here, it cash flows well, but I don't know that I'd get a big discount on this stock just looking at their cash flow and doing it in my head. If I multiply their free cash flow for the full year, which is basically 1.5 billion, and multiply it times 20, I get to about 30, and they're at 21. But that's for a growing business. These guys are not growing. So if I want 1 times cash flow, we're at 15. That's below that number. So this one's not really exciting unless you know something like, hey, Nokia is coming out with a technology that's really growing and really getting a lot of new customers. Now that might be something to be excited about. These guys were one of the original, mobile phone companies. I know for a while they were like really, really valuable, but I don't know if it's the case any longer. Um, that's my opinion on Nokia. It's a stock that I've seen from time to time. It just never looked right to me, like an investment that I would want to make, and it doesn't look that great to me at this point. Um, if they start to grow, they would really change their valuation because growing companies get a far better valuation. The PE ratio you use on a growing business is far better than a business that's just not growing, or a business that's losing sales gets a really low valuation. So if Nokia can start growing, they could potentially change their valuation, show better fundamentals, and go places. But at this point, I would not really be interested in Nokia. All right. And then Ericsson. Ericsson's, I think, in a similar. And it's Ericsson. So Ericsson, it's almost the same market cap, almost same ratio there. And this is Ericsson. Mobile connectivity solutions. Okay. And I think these guys do infrastructure for the communications companies. They pay a nice dividend, and their revenue has been slipping. This is in millions. I'm not sure what this currency is, but I could just go off the percentages. It looks like their revenue was slipping in 2023. Their revenue is higher than like in 2019, which is good. They had a really good year in 2022, but they had this and then it came down. It's been up almost 20% in the last year. It's had volatility. It's a low price stock at like $6.22. When we look at their cash flow, almost 2 billion cash flow there, but this is a different currency, so I'd have to do the translation there. So that's a Swedish krona, and so it's 10.59 Swedish krona to $1. Okay. So this is going to be about 180 million in revenue. Now this market cap, yeah, this one's going to be hard for me to get to a discount on this stock. Their cash flow is really low. It was at just the only year that was low. So free cash, no, see the prior years were much higher. Their cash flow is really low in the most recent year. See here, the cash flows were somewhat around the same number. Then it went up. It went up really well, and then it's been coming down. Yeah, it's not the trend that I want to see. I'd rather see the cash flows have been going up. The communications industry is like, it's rare to find a company that's just doing really well and really profitable. AT&T, Verizon, they're struggling. So the equipment makers that support AT&T and all the different communications companies, they're struggling because if AT&T can't make money, they're not buying more equipment. They're not investing in their infrastructure. So it's kind of the supply chain feels it when the actual company providing, cell phone service and, broadband and all that stuff, when they're not doing well, they're just not going to invest in the supply chain. So those are two companies. Historically, they used to be worth a lot, but now that part of the communications industry, I don't really have any investments in that area. The closest I come to it is Comcast, and Comcast is a more diversified company that's both in communications, providing broadband, but they're also in providing media assets like movies and so forth. And then they have those theme parks. So the closest I come to this industry is that company. All right. Thanks for asking that one. Bar drilling might be interesting. All right. So VU ETF, NVIDIA stock. All right. So you're asking like a 4-pack here. I'm going to be selective there just so I can save a little bit of time. So I'm going to talk about NVIDIA. So NVIDIA is a short position I've set up. I decided that, call it 2 weeks ago, no, about a week and a half ago. And I feel good about it. I think that NVIDIA is a great, great, great company. And they're seeing unprecedented amount of data center demand. But I don't think the demand is going to be staying forever. And the way the valuation is based is investors are expecting that NVIDIA is going to do that well for the next 10 years. And that's what I disagree with. Is I think the stock price is too high. And I'm setting up a small short position. I'll be adding to the NVIDIA short position each week if I still feel the same way. And I'll proceed accordingly. GameStop it's just too volatile for this investor. Man, the price action on that last week was just incredible. It was shooting up more than 40%, like in one day, just because Roaring Kitty was going to talk. That's not the investment for me. I want a business where I can figure out, hey, I really like what Uber's doing. I understand their business. They're growing their Uber network around the world, and totally get into that business and understand it, and understand that their stock price and their valuation is based on merit. It's based on the merits of that company, how well they perform. They're performing a valuable service that customers like, and they're going to keep growing. Uber. GameStop it's kind of like, I don't know what's driving the stock price. And if I don't know, I shouldn't invest. And that's what I've got to say about GameStop. So, all right. Neil, thanks for showing up. All right. First comment from Cinematographers. Great advice on real estate, current situation and projection. Yeah, man. For some reason, I was just made in a way where I just understand like real estate. And I bought my first property when I was 25, and I did well with it. And, it's what's interesting about real estate is like the first house I bought, I bought it for 175,000. And that's a lot of money for a 25-year-old 30 years ago. And I took all the money I had and I put it, and I signed the contract that I was going to buy that house. And I didn't sleep for 2 nights. I was so scared. I knew that mentally it was the right thing to do, but emotionally I was like, oh my God. That ended up being a great experience because the second transaction that I did was 3 times bigger, and I slept like a baby. And then I did other transactions, more money, slept like a baby. It was kind of like, I made a big deal. Well, emotionally, I just needed to get through that first experience. But, if anybody identifies with that, I'd be interested to see your comments. And I think, putting yourself out there and making a good decision is good life experience. That way, maybe today you make a decision that's worth $10,000, but in 5 years, you're making $1 million decisions, and all that practice around smaller transactions prepared you to make really good decisions when it really counted. All right. Are ETFs, mutual funds, good for an IRA? Absolutely. Especially, if you just want to bet the field. Like if you were to bet the field, the S&P is almost always a good idea. The one thing I would say on ETFs and mutual funds that I would say 90% of people's, advice would be always look at the expenses. Try to get the least expensive ETFs. Vanguard is one of the companies I think of when I go with low expense. And if you like certain industries or sectors that you think are going to do well, that's another way you can play them. So those are a great idea. So good question, Lynn. What are some of the best stocks you would invest into? Yeah. So I'm going to share my list. I'll go ahead and share it now. So here are the stocks that I'm buying into. Let me take a sip of water here. I'll go over the company. I'll tell you why. And let me set it up because investing is very personal based on what you want to invest in. And that's based on what you're comfortable investing. Your experiences kind of set you up to be a good investor in particular industries, sectors, things that you're really comfortable with. Second, where are we in the scheme of things? Are we in an expensive stock market? Are we in a discounted stock market? And where am I in my life journey? Do I need cash to pay for my bills? Do I not need it? I'm just a pure investor. So my situation is I don't need any of this cash that's invested. So I can, play a long-term game with growth stocks. And really, I'm looking for the best return on investment. Some of the companies that you're seeing that I'm not buying might be that, hey, I already own too much Chevron. So if I own enough Chevron, even though I still believe it's a discounted stock, I'm not going to buy anymore. One of the stocks that I decided I'm going to start buying into is Alphabet. I already own quite a bit of Alphabet. Okay. The value of it's a pretty good value. And can you guys see that okay? Let me make this a little bigger. And I'm going to... I just realized you wouldn't be able to hear me if I did this. So let me try to figure this out a little bit better. Okay, that'll be as big as I can make it. So I'm buying into Alphabet, and the AI demand is hitting NVIDIA, and the GPU demand is incredible. Well, Alphabet provides a cloud services unit, also known as a hyperscaler. And that hyperscaler is going to get a lot of the demand that you're seeing due to the AI market. So I'm buying into Alphabet. The next company, Meta. So I've seen prices for Meta just get to a point where, although I was holding off because I have a big position of Meta, I am buying more Meta. And Meta's rolled out their AI applications. My wife, she got invited because I shouldn't say invited. She's a Facebook user. And I think all Facebook users are being told, hey, you want to use the AI app on Facebook? And she said, yeah. And she's been playing around with it and it's quite nice. And then I was on one of their apps and it said, hey, Victor, you want to use the AI app? And I started playing around with it. It's really impressive. It's as impressive as, ChatGPT or Alphabet's Gemini. And I think about Facebook and I'm like, well, they have 6 billion platform users. So they can definitely roll out their AI to that many people like that. So just a huge strategic advantage in the AI market. So those are two AI plays that come with these great businesses. Alphabet produces free cash flows just by being Alphabet because they're Google search. You're on YouTube right now. This is a big cash cow for them. And they have the autonomous driving business. Meta, they generate free cash flow and they have cash coming out of their ears. And they have a lot of good things going on. And they have an AI business. So, yeah, I'll buy some more of that. I'm buying into General Mills, and I have a very small position. And I think that having some more consumer staples is a good idea for me. Prudential's been a really good performer. I've only been in this position for call it a year. I'm up 28%. I still think there's going to be more upside on Prudential. And then Catalyst Pharma, I really like this biotech company. The stock's really been beaten down. I'm still up 16%, but at one point I was up like 50, 60%. This could really go places. United Therapeutics is super interesting. I'm buying more of that stock. They do really well. Hewlett Packard's been having a really last couple of weeks has been doing really great, and it's just a really good, valuable company. So I wanted to buy some more shares in Hewlett Packard. Uber, I'll continue to buy Uber. Comcast, I'm building a position with Comcast, so I'm buying greater lots of shares in Comcast. Nike, which is a more recent investment. I don't have a lot of Nike, but I really love the brand and it's discounted in my opinion. I'm building up my forward position further. Starbucks is a huge, valuable brand and it's discounted. So I'm buying big into Starbucks. I'm buying big into Pfizer. I'm buying big into CVS. Personal story. I went to the doctor this morning, had a little ear thing going on. So I go to my local CVS and I'm not kidding you. There's a line with like 10 people at the pharmacy. I'm like, what's going on here? I never see this. And just one data point, but they're doing really well. Intel, I'm beginning to position there. Don't have a whole lot, but I'm kind of playing the fact that I owned Broadcom, made money on it, sold it. Then I owned Qualcomm, made money on it, sold it. And I'm just going to build up a position in the stock that I think is discounted. And then Adobe's had a really nice week, and software companies have been sold off. I don't know if you guys noticed that, but these really valuable software companies like Adobe were being left out. They were just being thrown away because everybody's buying into AI. And I get the AI is super sensational, but these are like awesome businesses. So I bought up, some Adobe, and it's really been rallying. So those are the stocks that I'm buying in the month of June. So thanks for asking. See if I can get back to, okay, cool. So Carolyn, you've asked like a lot of questions today. Thanks for showing up with some really good questions. Thank you. Yeah. Hey, Anderson, thanks for showing up. I appreciate it. And especially, I really like the feedback that people put both on the YouTube videos and really through these live streams. It just helps me understand, what's top of mind and what are areas that, people want to talk about. So appreciate it. Yeah. So I think I shared my stocks that I'm investing in, just some ideas out there. Till the end, LRCX, Lam Research. Okay. So these guys are doing really well. Lam Research Corporation design, manufactures, markets, refurbishes the services, semiconductor processing equipment. So this is some semiconductors are really booming due to the data center build out. It's driven by the AI demand, and Lam Research has really seen a big boost. Market cap of 125 billion, revenue of 14 billion, and very small dividend. I think this particular area worries me, and I'm going to get to it in a minute. Let me get to free cash flow really quick. So free cash flow, they did very well in 2023 at 4.6 billion. There's no way I can get to this valuation. And part of it is look at the growth. 1% growth, 17% growth, very good. 2021, great growth, but that was after they had kind of a terrible 2019 and okay 2020. So there's no way I can get to a valuation where they're at with their cash flow. And if the way I view it, let's see if we can get quarterly numbers. See, even the most recent quarter is showing us they're not growing their revenues. So why are people like just expecting that, hey, there's a data center build out for AI, and a data center runs artificial intelligence, but historically it's run other workloads. For example, a website or somebody's applications and so forth. Those things are not growing. All things outside of AI are not growing at the same rate. So will there be more demand for semiconductors for AI? Absolutely. Those are growing fast. But an example would be like Dell. Dell put out their earnings and they grew something like 3%. But their AI revenue doubled. But the rest of the business is pretty much not growing. So that leads me to believe that if you're providing basically the machinery to a semiconductor company, that semiconductor company like a TSM or an Intel, they're not seeing their volumes really pick up as fast as the AI market is expanding. No, you're just seeing that regular demand, or if anything, these financials are showing me that these guys are having a demand problem. So I'm not liking Lam Research. I think that they're not, the semiconductor company is directly benefiting from the AI build out, NVIDIA for sure. And then kind of a collection of semiconductor companies are going to be a part of that. But it's not going to drive higher semiconductor units overall. If you look at the whole basket of semiconductors, and that's why I would not be interested in Lam Research. Thanks for the question. Carbon capture and Chevron. I don't know. Do you think it's going to Scott? I don't know. I don't know how to answer your question. Carbon capture. I'm not familiar with that. I'm familiar with Chevron from an oil and gas, from exploring, finding crude oil and so forth. But I'm not sure how to answer that question. And I'm not sure how to answer that question, Neil. Assures Meta's brought you to YouTube. Yeah, you were surprised that I'm buying into Intel. We'll see how that works out. 2 stocks a week into cool. Those are the 2 you're getting into. Yeah, I really appreciate your questions, Carolyn. So with Lam, it's doing 10 bill buyback, 10-1 split. So they're doing a big buyback. Did they have a lot of cash? So they're doing 5.3 billion. Okay. They have debt of 5 billion. So where are they getting the cash for the buyback? I mean, they've got good cash generation. Yeah, I don't see a big stockpile of cash. I mean, if you want to see a huge stockpile of cash, you go to Alphabet, and you go to their balance sheet and you go, whoa, $111 billion of cash. Okay, that's cash. Woo. And then you go, well, how much do they have in debt? Total debt, $25 billion. So they have a net of $85 billion of cash ready to go. And if you looked at Apple, NVIDIA, Meta, Microsoft, they're going to look like this, which is why they're the most valuable companies in the world. Cinematographers. Adobe seriously compromised on sweet package terms. Service, effectively spyware, backdoor access to their creations. This is blowing up on. Interesting. I didn't know that. Very interesting. Josh, NVIDIA is doing a 10-1 stock split. Yeah, it's supposed to take effect on Monday. So if you owned one NVIDIA share on Friday, You're going to own 10 on Monday. Also own a couple shares, literally. Okay, cool. All right, good stuff. So good questions. The other stock that I began to short last week was Tesla. It's a stock that I kind of kicked myself. I've done a couple of videos on Tesla going back, a year. And on each occasion, I'm like, man, this stock's, severely overpriced. Well, it continued, it was correct and it kept going down and down. Well, it's great to like see something and call it out, but I'd rather make money. And, I started a small position and given a really expensive stock market, it's getting harder and harder to find a discounted stock. And it's almost like I'm trying too hard. So instead of doing that, I built up my cash position and I'm going to put a certain percentage of my portfolio into short positions because I think that's probably going to be a better return on investment as opposed to trying to find the next really discounted company, which is becoming harder and harder as the stock market continues to go up. Now, it's great to see my stock prices go up. Thank you, Mr. Market. But again, every time the stock market goes up, it makes the idea of short selling a stock even more attractive to me. So I'm going to begin to use that tool in the toolbox very carefully. I'm going to try to manage the risk, but that's what I'm seeing in the stock market, and I wanted to adjust. All right, so winter is coming. Thoughts on Paycom and then Alvi. Okay, cool. So Paycom. So software companies have been really discounted recently. I think because everybody's like, a lot of investors are just super excited about AI. So they're putting their investments there and forgetting that there's a software industry that's really profitable. These guys do cloud-based human capital management software. Okay. And it's a small cap. The revenue is 1.74 billion. Small dividend, reasonable forward PE. Looks like nice growth. See, I made a comment earlier that the data didn't make me comfortable. This data makes me really comfortable. Growth, 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 growth. That's a very nice data set. That's a nice growing company. All right. So that looks really good. Revenue growth looks great. Their balance sheet, they have 294 million of cash. They have total debt of nothing. That's a beautiful number when it comes to debt. All right, Paycom, you're looking good. We look at free cash flow, $292 million of free cash flow. They're growing, 293. Their stock price year to date is down. This is a really interesting company. This is a really nice stock. I like a lot of things that I'm seeing. And yeah, this is a good one. I'm going to circle that guy and do a little more analysis. So Paycom, I like the software industry. So my three areas of making a decision on stock, I got to really like the company. I got to really like the industry. I got to really like the management team. I can tell you I like the software industry. I can tell you I like this company. I think they're in a good space. They're really, compared to other software companies, they're small. They can continue to grow. And I like their balance sheet. And I think once I do evaluation, this one might be discounted. So this one's worth, putting some time and energy into it. Analysts believe it's 52% discounted. And if we look at their forecast, their earnings per share is 2024, $7.94 per share. It's going to grow in the future. Man, I'm seeing a lot of good things in this stock. And I think part of it is, again, the AI energy or interest is taking money away from software companies. Well, I think it's a pretty good idea to look at software companies when they're being discounted. So that's a good one. Then the other one was All V. All V. Okay, I don't think it's that one. So I don't think I can get to that one if it's a foreign company. Sorry, I can't get to that one. But thanks for suggesting Paycom. Talked about Intel. All right. Anderson, 2.8% of my portfolio is short via VIX. Concur with your thoughts. Yep. All right. So how would you prepare for a crash? So that's a good question, which is, so crashes are like, the last crash we had was due to COVID, and I didn't see COVID coming. I don't know if you guys did. The one before that was the big subprime mortgage meltdown. I didn't see that coming. And the one before that was the dot-com bubble, bursting. That one, I would say more people should have seen it. What we're building towards is more like the dot-com bubble, by the way, especially around the AI space. I think it's really setting up to really just blow up, and a lot of companies are way overpriced right now, and we'll see which ones get really, really, brought down. But I would say that I'm adjusting to my age. I'm 55. If I look at when I was 25, growth, just figure out how to earn more money. That's what I was focused on. 2, invest in growth. I've got 30, 50 years to go. I just want to grow my investment. And, if you're 35, it's ditto, just keep growing. 45, all right, maybe start balancing. Now that I'm 55 and maybe, I don't know when I'm going to retire, but I want to get good at having fixed income. So I'm really adjusting toward, how can I have some fixed income in my portfolio? So when the day comes, I can generate enough income from my investments to pay all my living expenses, everything, without touching principal. That'd be really cool to accomplish. So that's what I'm working on. But a crash, I don't think about crashes, and I don't think about, because they're so hard to predict, even corrections and pullbacks. I'm not necessarily waiting to invest until a pullback happens, but I would say I built up my cash position to be ready for the next pullback, because I think the chances of a pullback are much higher since the market's really been on a tear for the last 18 months, about 18 months. The market's up 50%. That's great, but it's not going to last forever. We're going to have a pullback at some point. So thanks for the question. PayPal, any thoughts? I like PayPal. I've bought a lot of PayPal. I'm not buying anymore because I bought enough, and I think it's had a nice week. They need to have a good month and a good quarter, and I think there's a lot of value they can unlock, and there's a lot of value there for investors to appreciate. So I like PayPal. If my broker offered the functionality, I would short individual stocks. There you go. Okay. So it's 40% chance for a stock option, good or bad? For a stock. I don't know. I'm not sure how to frame that question. Meant to say 40% chance of profit for a put. I don't know. Options is not my game. Like, I short stocks because I think options are interesting, but they make investing harder. They don't make it easier. I like simple and a repeatable process to make money, and I stay away from options. But that's just me. A lot of people use options effectively. Look for other investors that are good at options and seek their advice. Do you see possibility of an 07, 09 real estate? No, it's not going to be. Well, so I've used this phrase, which I believe in, is history doesn't repeat itself, but it rhymes. What led up to the subprime market meltdown was the wrong loans being given to the wrong people. And then that created a big domino, effect. And I think we are setting up for that because real estate prices are too high. And at a certain point, when they start dropping, a lot of sellers are going to come out of the woodwork and start selling their homes because they're like, oh, I want to sell it now before it drops even more. Well, that's actually that additional supply is actually going to make prices go down even faster. And people, like real estate moves really slow. It's not the stock market. Like stocks can move up, over the course of a month, a stock could move 25 to 50%. Well, real estate will move in 1/4, a fraction of a percent. You just don't really see it until you look back like 5 years later. So I think that we could have a pretty good correction in real estate, like 20 to 40% prices dropping, depending on which market would have a different percentage rate. But it takes so long to see it. You have to look back over the last 2 to 3, 4 years, and then you can clearly see it. As time passes, you have to kind of like monitor it and study it carefully. So are we going to have like a really big meltdown, like, leading up to the 07, 08 timeframe? I think it's going to be something like that, but not exactly like that. I think that had its own set of situations or drivers. And I think this one's being driven by just prices are way too high and you have an increasing interest rate market. So that's my best guess at it. So, yep. Thanks for the comment. And yeah, and again, back to, corrections and stuff. Will there be drops in the stock market? Yes. But the mentality that I have, and I think that a lot of, like if you look at the Warren Buffetts of the world and so forth, is in general, they stay invested. And it doesn't mean that you can't build up a little bit of extra cash because you feel like the market's, overvalued. It just means that, let's say I got out of Meta, getting back in is going to be really hard. Getting back into Meta is really, really hard. I sold Amazon at the end of 2023. It was a very successful investment, got out, made money. Now, getting back into Amazon is going to be hard. Now, it's a great company. So if you do that too much and the market continues to rise, you find yourself a little bit, on the outside looking in. So I don't make these drastic moves. I'm going to sell 50% of my stocks and create cash, right? I went from, I was maybe 5% cash to 7% cash. And now I'm up to like 10, 11% cash. So we're not talking about huge amounts. And we're talking about moving from, 5-7 to 10-11. Can I grow my cash from this point? Probably not. If I forced myself, I could. But I think that's a comfortable spot because if stock prices pull back, I'll have the cash to incrementally buy into the positions that I want without ever selling one stock until I see that a company's maybe changed and I don't like it anymore. Their fundamentals have gotten worse. I just need to get it out of my portfolio. Okay. So thank you for the question. All right. So I think it's a good time to wrap it up. Thanks so much for tuning in. I really appreciate it. Really like all the comments on the channel and really appreciate everybody showing up today and asking really good questions. And let's see where the market goes this week. In departing, we have a big Wednesday coming up. This is where in the inflation rate report is going to be announced, and we'll see if inflation is high or low. If inflation measures low, like it's expected to come in at 3.5 year over year, let's say it came in at 3.2, the stock market's going to rally like big, like holy smokes. The NASDAQ's up 2-3%. The S&P's up 1.5%. If inflation comes in and let's say it's a 4, it's too high. Oh my God, the Fed's going to have to raise interest rates or they're going to have to keep interest rates higher. you're going to see the S&P go down a point, like a whole 1%. The NASDAQ could go 2-3% negative. You'll see a big sell-off based on that report, and that is followed. The report's in the morning, and then the Federal Reserve will meet, and they'll make a decision on interest rates that they're going to be supporting. So Wednesday is going to be an important day. We're going to see either numbers that came in line, and you're not going to see a big change in the stock market. But if there's a surprise, we could see a market that's much more expensive on Thursday or beginning to get discounted on Thursday. And I would expect a trend downward from that point. That could be the kickoff to a nice correction. So we'll see what happens on Wednesday. Stay tuned. Everybody, thanks so much. Enjoy your weekend. And thanks again for tuning in.